Good afternoon, ladies and gents, and welcome to LAT's Weekly Market Insights. As we come across the calendar, we can see a week which was dominated by two major central bank events, one being the Fed in the US with their interest rates, which was Wednesday evening, and then the BOE and Andrew Bailey here on Thursday at midday. And we'll kick things off on the Wednesday. Jerome Powell and the Federal Reserve were in action at 6 p.m. and they decided to raise rates by 25 basis points. Now, this was an eagerly anticipated release. There'd been a huge amount of speculation as to what was going to happen next. In light and in wake of the fact that SVB had put additional pressure on Jerome Powell and his committee to consider their rate hiking cycle and potentially looking to adjust their forward guidance. And now the initial response to the 25 basis point hike was a dovish hike. We saw the S&P 500 respond somewhat positively to the news, and that was in line with the fact that the terminal rate of 5.1% was unchanged. But it's now trading at 5%, peak hawkishness well and truly priced into the market, and therefore opening up the possibility for rate cuts, a more dovish stance, and ultimately a bit of an easing off in terms of this, what has been a very extreme rate hiking cycle. Now, any sort of hope that was given to the markets was somewhat diminished as we went into the Q&A session later on, where Jerome Powell was asked for sort of a bit more forward guidance and future guidance as to what was likely to happen. And he came out with some far more hawkish comments, and that one of those comments being that his committee, not one of them had expected to see rate cuts in 2023, which was somewhat priced in, but there had been some concept of perhaps there could be some rate cuts towards the tail end of the year in Q4. That was sort of firmly put to bed. And then he went on to go and reiterate the fact that they will respond meeting by meeting according to the data. And he reinstated once again, but he said if the Fed needed to, he would raise rates higher, but not for now. Okay, officials, he said, see the likelihood of credit tightening, and the impact of this can be seen as another hike. So started off certainly very dovish, peak hawkishness priced in, S&P responded somewhat positively, and then we took a turn and we turned slightly more negatively, more hawkishly, as he once again alluded to the prospect that we will wait on data. Now, what that enabled us to do was respect this level. This was a very, very significant resistance level. We'd seen this level in play. It sat just above the 4,000 handle, but it was a very high volume, big reactional level where we've previously seen very strong selling back on the 9th of March. Now, we popped our head above that level, failed where we'd once seen previously strong selling before, back in again on the 7th of March, and then we saw this aggressive move lower off the back of that rate decision. Now the trade since then generally has been bearish here for the S&P, but it's chopped and changed coming in towards the tail end of the week. We saw a run back up towards the highs before ultimately rolling over again on sort of pre or just after US cash open on the subsequent day on Thursday. Euro dollar on the other side to that reacted very, very, very positively, and this was of course a dovish statement. This was a bit of a divergence here with the ECB. Still a fair bit of work to do in terms of raising rates, and the US, the Federal Reserve and Jerome Powell potentially a peak hawkishness. So here this move that we can see up through here is the reaction. This is that dovish response, a weakening of the dollar, and that divergence between two central bank policies enabling euro dollar to move higher. Now since then there's been a pretty sharp turnaround and a drive back lower here. Now we're back trading sort of where we were in the middle of this sort of bullish move, I guess. And again, pressure coming onto euro dollar here, but once again from a very significant level. We can see, similar to the S&P, we have failed at levels where we've previously seen very strong selling, trading at that 109.30, 109.50 region. And negativity starting to flood back into this market. The same questions that were there pre this announcement, this release, are still there today. We've still got the same questions. Is SVB something that's systemic? Is it a contagion? Is this the start of further problems for the Fed? Or is this something that there's been an overreaction to, and the steps and prevention measures that put in place for the banking system is enough to shore this market up? Time will only tell on that, but certainly for now it would appear peak hawkishness is priced in. That inflation picture still still plays center stage, but with inflation still coming down, perhaps we can see at least that peak hawkishness scenario unfold. Now, the way the markets are trading and the resilience and the struggle to move higher here suggests that those risk-off flows still continue, and therefore perhaps markets, whilst accepting peak hawkishness, is feeling uneasy and uncertain around the current financial banking situation. In terms of on UK and home soil, 12 o'clock, we had the MPC and the BOE, Andrew Bailey, in action. And they also in line put up a 25 basis point hike to 4.25%. Now, one of the key comments around this falls when we're discussing Credit Suisse and the UBS takeover. And again, it comes down to the robustness and the strength of the banking system. And the FPC judges that the UK banking system maintains robust capital and strong liquidity positions, and is well placed to continue supporting the economy in a wide range of economic scenarios. Okay, including in a period of higher interest rates. Okay, ultimate summary from that is that the UK banking system, despite what's going on with SVB, Signature Bank, Credit Suisse, the UBS takeover, they are still of the opinion that the UK banking system is resilient. Now, the one challenge that was put up here in front of the BOE was the consumer price index, the inflation data that came out on Wednesday. Now, we were expecting a draw down to 9.8%. We came out a miss on expectation and a build on the previous month up to 10.4%. Now, despite that big miss on consensus and also a miss on the previous figure, there is still a belief that, and the committee believe, that inflation will still come down significantly by the end of 2023. So that the initial response, the initial reaction to that inflation print was most certainly negative. We can see that on Wednesday. Here we go. Let's just have a circle that for us. Okay, this was that 7 o'clock data release. The inflation print coming out higher than expected. Markets taking that as the Andrew Bailey and the Bank of England are going to have to take a more hawkish tone, looking to raise rates to combat inflation, and therefore driving the FTSE 100 down. Now, the comments much the same really as the Fed. The comments that then followed took a more opposing stance, reassuring us that they felt inflation was still likely to fall very heavily over the rest of the year, and that labour conditions were still in line with where they thought they would be, and therefore no need to turn to any more hawkish than they currently are. Now, that enabled the FTSE to rally higher, but again, much the same as we're seeing in the US. Despite the comments, there still has not been enough evidence within this market to keep it up. And we've transitioned into this beautiful downtrend here on the FTSE 100, creating lower highs, lower lows, very technical trading on our way down to where we're trading here at the moment at 73.66. And this just continues and progresses that much larger sell-off that we've seen from the 8,000 handle here in the FTSE 100. Now, looking at how this chart is progressing from that 8,000 handle, trading up the highs where we saw that big beautiful rejection with a dark cloud cover formation, back-to-back bearish Maribozus coming in, and ultimately surrendering these previous highs. Very, very strong resistance. The highs from the sort of pre-COVID world back in January of 2020. Now that we're trading back beneath there, having given that level a little kiss on the way through, very hard to see too much further upside here in the FTSE 100. Very much downside opened up towards these lows, trading down at 6,800, that 7,000 handle looming, very present. And those inflation prints certainly supporting that. Again, despite that, as we said, despite the commentary from Andrew Bailey and the BOE suggesting that the banking system is stable, the risk-off flows filtering through into the market still to this day. That couldn't be more evident than in the gold markets here at the moment. Okay, gold here now trading up at that 2,000 handle, big significant resistance holding, but with for a first time for a very long time, we have transitioned back into very much risk on and risk off flows. Gold, which had traded very much as a dollar proxy, is now trading as it historically used to in a pre-COVID world, of risk on and risk off. And here we're seeing risk off flows into safe havens such as gold, and we're also now starting to see the yen's dominance come back through. Of course, this aided by intervention by Japanese governments and central banks, but we're starting to now see the Japanese strengthen in light of these risk-off moves. And of course, as always in risk-off scenarios, bearing the brunt of this, the Australian dollar has taken a significant move lower. This major downtrend continues on its way. And looking at the ultimate sort of correlation cross, the Australian dollar getting hit hard, that commodity currency, that risk currency, selling off hard when priced against the yen, the safe haven. We've seen very exaggerated moves to the downside, and Aussie yen here now taking out some very, very significant lows. This is the low from December of 2022. We just pop this into a weekly chart. Okay, we can see here now, we had numerous attempts at this level in May of 2022, December of 2022. We're now down through that. If we can take out this little previous high and get below that, there's not a huge amount to prevent this from falling significantly lower, down to around that 80 handle, big psychological round number down there at 80. So very, very traditional risk on and risk off flows here at the moment, a risk off following through that SVB banking crisis, dominating here, taking probably more significance than the central bank policy, which has been somewhat figured out, priced in. Not really any surprises coming through this week. Somewhat dovish hikes across the board, but really it's just the short-term reaction to the announcement and then ultimately risk-off flows persisting and continuing through. And just as we sit here looking to the European session, so far from today at least, it has been a choppy and a rough time, pretty awkward period here for the DAX. We can just see a pretty significant sell-off from 15,180. Taking us down to 14,800 here. So significant sell-offs here to close the day on the Friday. Those risk-off themes continue. Yes, it's risk-off. Yes, there's huge fundamentals in play here, but never forget we've got beautiful technical downtrends unfolding here, and no reason for me why the DAX can't continue on its merry way down. The next real sort of key area to look for here is around this 14,700 region, and then ultimately onto the low right the way down through here, 14,500 sitting just above that low here as the next big psychological round number. So risk off flows way through. I think that's playing a more significant role than any of these rate decisions. They were very much in line with expectation this week. We'll have a look towards next week and see how this data progresses, but central banks continue on their current path. Peak hawkishness not far off for the Fed and for other central banks, and they'll be waiting on data to suggest where we are going next. Okay, so that's it really for this week. Hopefully you've enjoyed the volatility, the ongoing volatility that's been in the markets. If you've traded and been profitable, well done. If you haven't, I hope you've managed to learn from some of your perhaps errors or mistakes and roll on next week. Alrighty, please do join us same time next week for another weekly market insights. Bye for now.